We think women need to talk more openly about money because money really matters. It shouldn't be embarrassing or confusing. Join the conversation. We'll be discussing a whole range of topics which will help you get comfortable with your finances. Money Matters. Brought to you by AJ Bell.
Hello and welcome to AJ Bell Money Matters podcast. I'm Laura, and in this episode, Danni and I are going to be giving you a beginner's guide to mortgages.
Yes, hello. We get so many questions about how mortgages work, how the Bank of England's interest rate decision impacts on mortgages, and what are the differences between trackers and fixed rates.
Because we've seen so many headlines about mortgages, but I think sometimes it's really good to just talk about it in a jargon-free way so that people don't feel anxious about the fact that they don't know some of the lingo involved. So we will be doing that, and that will be our one big thing for this episode. And we've got our special guest today, Kalpana Fitzpatrick, who is a financial journalist, and she is an author of a couple of books, including Get to Know Money, which is aimed at kids, because a lot of parents worry about teaching their kids about managing money and how they go about those conversations, especially the more complicated bits like mortgages when they get older. So this episode of the podcast should help you out if you're a parent or you have children in your lives and you want to talk about money with them.
Yeah, because we do get lots of people also asking about things like pocket money, kids' bank accounts, and investing for children in junior ISAs and that kind of thing. So, yeah, we caught up with Kalpana to pick her brains about the different conversations needed for different ages. And she is actually quite jargon free as well. So, that was good.
But let's start with mortgages, as we promised, because this month, which is August 2024, if you are listening back to old episodes in the future, the Bank of England has cut interest rates for the first time in more than 4 years. The last cut came as the UK went into lockdown way back in March 2020, and probably the less said about that month, the better. But in December 2021, inflation was hotting up, and the Bank of England started raising interest rates, and they ended up at 5.25% last August. Then the Bank of England decided to keep rates at that point for a full year. But we now have inflation back down to the bank's 2% target. The economic climate was such that of the 9 members of the bank's monetary policy committee who will decide what interest rates should be, 5 out of those 9 members voted for an interest rate cut, which brings it down to 5%. So it's gone from 5.25% down to 5%. But the past couple of years have obviously been very unsettling for lots of people with mortgages who might have experienced very high interest rates like they have never experienced before.
Yeah, I mean, it has been a really difficult and worrying time for a lot of people who, as you say, might never have experienced interest rates as high as they have been. And to put it into some kind of context, the last time rates were at 5% was April 2008. Now, that date, of course, should ring a bell because it was the heart of the financial crisis. And in response to that, central banks lowered interest rates to help the economy fight back from recession. By February 2009, they were down to 1%, and they stayed below 1% for 13 years until July 2022. So, for lots of homeowners, ultra low rates were normal. They were just what you budgeted for. But actually, if you look back before the financial crash, they sort of vacillated between 7 and 4.5%. And if you had a mortgage back in October 1989, you'll have seen the base rate jump to almost 15%. But of course, and we get a lot of people talking about this, well, I remember when my mortgage was really high. And I do remember my first mortgage was 6 and a bit percent. But of course, house prices were also much lower. I was looking at land registry figures, and it showed that the average house price back in October 1989, I feel I need a drum roll here because I was just quite surprised. £59,000, £533, Laura.
That
That's
is, I mean, it feels mad, but we obviously have to take into account, inflation and the average rising prices during that time. But yeah, my parents always talk about buying their first home for like £30,000 or something ridiculous. So yeah, that feels like a world away, doesn't it?
It does, because May this year, £285,000, just over, for the average property price. So, that just gives you an idea.
And obviously, I touched on it there. Inflation means that the price of everything has risen during that time, and also wages have risen in that time. Someone buying a house in 1989 would have been on a much lower annual salary. But if we look back at wages, they actually haven't kept up. So if we look at those 1989 figures from the ONS, they put average weekly earnings at just over £200 a week. This year, that is up to £672 a week. So that represents a just over 220% increase. In contrast, house prices have risen by almost 380%. So we can see that house prices really have outpaced average earnings. But there are so many, different factors that go into whether house prices are more affordable now or not. It's the generational debate, isn't it? Nationwide has been looking at affordability for first time buyers, and they estimated mortgages would be 28% of take home pay in 2019. But by this summer, that's gone up to 36.5%. And of course, all of this is for people that can actually manage to pull a deposit together to get onto the housing ladder and have sufficient income to be able to get that mortgage in the first place. Usually, the typical route is clubbing together with someone, whether that's a partner or a sibling or a friend, in order to be able to get on the housing ladder. And of course, that has got much harder with rents rising in the way that they've done in the past couple of years, leaving people with much less disposable income to be able to save to get that deposit.
I was talking to a friend at the weekend whose daughter is 25, lives in London, has a really good job. She's currently renting with friends, and she does not see any way that she is ever going to be able to afford to buy a place in London. So, potentially moving back up north, which is where her parents are from, but it's an incredibly difficult calculation to make. There is some good news, though, because as Laura said, the Bank of England has started to bring down its base rate. But there's a lot of confusion about how that impacts mortgages. So we like to bust jargon and really simplify things here. Let's clear that up a bit. At its basic, mortgage is a loan from a bank or a building society to you so that you can buy your house. Because I don't know about you, but I certainly don't have a couple of £100,000 in cash
I
just lying
wish.
around. Yes. So we borrow the money. We borrow the money from our lender, and we agree to pay back that sum over a period of time, say 25 years, though in recent time, 30 or even 40 years has become a lot more common. But that, of course, isn't the end of it. It is quite complicated because the terms of that agreement, the amount of interest we pay for that loan, we don't normally agree that for the full term. Now, the most popular type of mortgage is something called a fixed rate mortgage. UK Finance reckons that over 70% of all mortgages are fixed. Now, that is a mortgage that allows you to keep the same interest rate for a period of time. So you know what you're paying for a while. The most popular is 2 years that you fix the rate for. But you can get 5, 7, 10, or even longer, though they tend to be quite niche. The rate that lenders offer you depends on a whole load of circumstances, from your credit history, how much you want to borrow versus how much your house is worth, which is also known as the loan to value. And that is where, of course, your deposit comes in if you're moving home or buying your first home. If you're looking for a lender to stump up 90% of the cost of the property, they're going to give you less favourable rates than if you're just after 50%. You might wonder why the fixed rate that you're offered is not whatever the base rate is, because it would seem to make sense, wouldn't it? But remember, your lender's also a business. They need to make money from the transaction to pay their staff, to make a profit, but also to pay the people that they get the money from. Some of it's going to be from savers and they get interest payments. Some of it will come from other financial institutions. And you might have heard over the last couple of years the term swap rates, because that is how much it costs for your lender to borrow the money to lend you. And that changes. And that will take into account the base rate, but also what they expect the base rate to be over the full term of that loan period. And then, of course, adding all the extra bits on top to make sure that they can pay wages and make a profit.
Exactly. And now, while Danny said, about 70% of all mortgages are fixed rate, there are other types of mortgages in the UK that you could be on. So, a tracker mortgage, and this is where it does track the Bank of England base rate. Now, it won't be exactly what the base rate is for all the reasons that Danny just explained, but it means that if the base rate goes up or goes down, then your mortgage rate changes often a couple of days later or the following month. In line with that Bank of England change. And so for people that don't want to fix in a rate, they can opt for one of these tracker mortgages. And then the other type of mortgage that you might be on is called a standard variable rate. Often shortened to SVR jargon here. And that is basically the lender's most expensive rate that you could be on. And at the moment, they are sky high. They are 7, 8. I think they even touched near 9% at some point for some lenders. And this is basically kind of like the default rate that you'll fall on if you come off your fixed rate deal that Danny just explained. You get to the end of that 2-year period, for example, that you'd locked in and you haven't arranged another mortgage, then you will fall on to this standard variable rate and it will be very high. You want to avoid that at all costs by locking in a new mortgage rate when your fixed rate deal comes to an end. But it's definitely worth being aware of what they are and how much they could be. And in all of the kind of reams of paper that you get when you sign up to a mortgage, it will tell you what this standard variable rate is going to be. But they tend to go up as the Bank of England base rate goes up. And we would hope that they will start to drop now if the Bank of England cuts interest rates more. So those are the kind of main types of mortgage that you can have. But obviously, the good news is that that Bank of England base rate dropping does translate through into mortgage rates. So we have seen particularly fixed rate deals drop in the build up to that expected cut from the Bank of England and since that cut. And as we see more cuts from the Bank of England, which is what's expected, but obviously not guaranteed, we would see some of those rates drop. So at the moment, as we record this, your best 5-year fixed rate mortgage is 3.84%, and your best 2-year fix is at 4.22%. Both of those are with Barclays. There was a lot of fanfare when that 5-year rate fell below 4%, because that was a key point that it hasn't done very much while interest rates have been high. And like I say, we would expect those rates to keep dropping as Bank of England cuts the base rate again. And then for those that want to track a mortgage, the best tracker rate at the moment is 4.89%. So less than base rate is at the moment. And if you went on to that tracker deal, if the Bank of England cut interest rates again, then you would see that same reduction in your mortgage rate as well. But there are lots of people that are having to make these decisions this year. So UK Finance says that around 700,000 fixed rate mortgages are due to come up for renewal in the second half of this year. So some of those will have already happened, but there's a lot more that will come before the end of December. And so these are the kind of questions that those homeowners are going to have to tackle is, do I go onto a fixed rate deal? If I do, how long do I fix for? Do I opt for a tracker deal and hope that the Bank of England keeps cutting base rate and I benefit from that? But the main thing you really want to be careful of is not falling on to that standard variable rate, because that will be very expensive. And particularly if you have a lot of mortgage borrowing, so you have a larger mortgage, then that jump, even for a couple of months, onto that really high interest rate could have a very huge impact on your finances and how much those monthly payments are going up by.
And of course, for most people, when they're coming to the end of their fixed rate at the moment, they are going to find things are more expensive. Although, remember, we spoke about the mini budget September a couple of years ago. So there is a chance that when you come off a 2-year fixed this September, you might actually find things are getting a little bit cheaper for you. But for a lot of people, myself included, I'm still on a fixed rate. I've got another year and a half. So I'm certainly thinking about where interest rates are going to go. And I've just pulled up market expectation of when they think the next rate cut will be, potentially where they think that rates are going to get to. And well, it's most people don't expect we'll see another cut in September. most of the expectation is that maybe by November, before Christmas, we'll see another quarter percentage point cut to 4.75%. But it looks slow going. So I know a lot of people are sort of saying, when are we going to get back to those ultra low interest rates that we got used to? Maybe that's, when you bought your house, you had ultra low interest rates. You've never known anything above that, 1% base rate. And now you're having to deal with the fact that we're not going to get back there unless there is a huge financial crisis again, like we have, another pandemic, or we have another financial crash or something of that ilk. Expectation is that 4% might well be the sort of area that rates get to and then hover around that for a protracted period of time. And that means that for a lot of people who really stretch themselves, maybe then they've made changes to their mortgage over the last couple of years, they've extended the term, or they've gone interest only, which means that you're not actually chipping away at any of the loan amount, you're just paying for the privilege of having that loan. They're now at a point where they're realizing that they might have to think again about the house that they own, whether or not that is right for them. And I've spoken to lots of people, Laura, over the last couple of years who've made the decision to sell up, to downsize, because they just didn't feel it was affordable to carry on in the way that they were. And I know a lot of people are still making quite difficult choices because house prices are still going up.
Yeah, and I think if you're looking ahead to your fixed rate deal coming to an end, or if you've fallen onto that standard variable rate, then it's a really good idea to speak to your mortgage company. If you're worried about making repayments or you're already struggling to make them, there is what's called a kind of a mortgage charter, I think it's called, which came out when interest rates got really high, and it puts the onus on your mortgage company to give you a certain level of support. Now, that support isn't going to last forever, but it can really help you out in terms of allowing you to extend the term of your mortgage, even if you're partway through a kind of fixed rate product. So that has the effect of reducing your monthly repayments because you are extending the amount of period, the time period that you're borrowing over, or switching to an interest only mortgage, like Danny just talked about, which can reduce your monthly repayments. So if you're struggling, then definitely bear that in mind. There's a few other things that's probably worth talking about. If you're in the opposite camp and you find that you have some spare money, you can overpay on your mortgage. So pay more than your monthly amount that you have to pay. You should check with your mortgage provider. There's limits on how much you can overpay. So you can't just, if you came into some money and you wanted to pay off your entire mortgage or a large lump sum, then you would likely face what's called an early repayment charge from your mortgage provider if you exceed their overpayment limits. For most, it's 10% of the outstanding loan amount. So if you've got £200,000 left on your mortgage, you could overpay by £20,000 a year. So it's usually quite generous limits. So definitely check that out and look at whether that's something you want to do. I've definitely heard of some people doing that in anticipation of their monthly payments going up. They say, okay, well, when they come to refix their mortgage, they say in the interim period, I'm going to start paying a bit more towards it. So it's not such a stark jump from what I'm paying now to what I'm going to be paying when I get a new mortgage. So that's another good thing if you find that you do have a bit spare money.
And remember, if you are coming up to the point where your fixed rate is coming to an end and you need another mortgage, you can actually agree an amount 6 months ahead of that mortgage coming to an end. Now, of course, that was much more of an issue when we expected interest rates to be going up or even staying sort of fixed as they have been. Now they're coming down. You might think, actually, maybe I'll just sort of wait and see, but you can agree an amount and then that can be changed when you get closer to the date when that fixed deal comes to an end. And as we've said before, it is always worth talking to a mortgage broker who might be able to see a whole lot more options than you are able to see and give you some really good advice. I just wanted to mention one thing because we were talking earlier about house prices and how certainly some of the older generation have been saying, well, we had much higher interest rates. I don't know what all the fuss is about, but as we spoke about earlier, house prices a very different kettle of fish to what they used to be. But I know a lot of younger people are really struggling just to try and get their deposit together in order to take that first step on the housing ladder. Now, we don't know quite what this new government might have in store. They have said that house building is a top priority. Whether or not they create some new help to buy scheme, whether or not they look at changing some of the terms of the lifetime ISA, because that in itself is not a great product for people, particularly if they're looking to buy in London and they might find themselves priced out of using that. And, in terms of being able to get the whole of the government money that you can get every year, because if you invest £4,000, the government will top that up to £1,000. But for a lot of people, finding that £4,000 from their salary when rents are so high is really tough.
Yeah, exactly. But it's definitely worth, like you say, there's help out there and there's things out there that people can do to help get that deposit together. But I think every time you read those stories in the newspaper of like how we afforded to buy our home, generally it comes with, I either lived somewhere rent free, whether that was my parents or with a partner's parents. You're buying with a partner or with a sibling, and or you've had a lump sum of support money from parents, grandparents, inheritance, something along those lines. And so I think it's also really important to acknowledge that stuff, because if you're out there and you don't have any of those avenues of support, then and all the people around you are buying homes and able to purchase property and you're not, you might start to feel like a bit of a failure. But actually, I think if we look around at lots of people that have been able to afford to do it, it really does come from, family support or having a kind of super high paying job or a partner that has a really high paying job. So it's important to bear that in mind, I think, because I think people do get quite frustrated when they're trying to save for that deposit and seeing other people buying around them.
Particularly when you see sort of commentary about people saying, well, if you just cut back on your daily coffee or you just get rid of one of your subscriptions, then, that's how you could potentially buy a house. I mean, I was incredibly lucky. I got a 100% mortgage when I bought my first home, and my house price was, well, nowhere near the average house price now. So I feel for all those people who are getting incredibly frustrated seeing house prices go up and just feeling that the ladder, that first rung, is getting further and further away for them.
Yeah, definitely. But now it is time to hear from this week's special guest. So, we often get asked for tips on teaching children about money and finance, when's a good age to start, how to create healthy financial habits, where to find help. And I certainly have all of those questions for my daughter. She's almost 4, so probably a bit early to be learning about that stuff. But I definitely think there's some good habits that you can instill in kids from a very young age, just to kind of try and teach them about the value of money in easy ways. But luckily for me and for everyone else, we have roped in Kalpana Fitzpatrick, an award winning financial journalist. She's already written a book on the subject called Get to Know Money. And here is what she had to say.
So, thank you so much for talking to us. It's brilliant to have you on the podcast. Um, we've spoken before about the importance of teaching kids about money, but it can be quite daunting. So, I suppose a lot of parents might wonder, what sort of age do they have to be before you can start?
Well, it is a really important subject, and it's probably one of the most important lessons that parents can give their children. They're not going to get it at school as soon as they start. So, at what age do you start? Well, I'm going to say as young as possible. So, if you were to say 4, I'd be like, yep, go for it. But actually, research from Cambridge University does show that children start forming money habits as young as 7. So actually, you do want to start teaching them about money way before that. So if you've got children that are aged 4, 3, yes, talk to them about it. Obviously, if they're just born, don't talk to them about money. So as long as they're at a stage where they start understanding things. Now, I've got children of my own. I've got nieces and nephews, and trust me, at age 4, they start understanding money very well. They do understand materialism. If they understand materialism, they understand money. You are ready to talk to them about money.
And I guess when they're that sort of age, it's got to be done through play. And there are some brilliant toys out there. I remember my kids having like a little supermarket set up where they had a till and they had the fake coins and they would play at, coming and buying stuff. And that sort of thing is a good way.
Oh, absolutely. And do you know what? Play is one of the best ways to start teaching children about money. Now, I'll just put this in here as like, it doesn't have to be a maths lesson. So parents don't need to panic saying, oh, I don't know anything about money. It's literally, you use it every day. It's part of your everyday life. Make it part of their everyday life. So one way to start playing is you don't actually even need to go and purchase anything. If you go to the shops, for example, let them start picking, things, and like let them tap the card. I used to let my little boy tap the machine, and he used to call it my money card. Can I use the money card? And it was good fun. It was just, but it's that little interaction that gets them thinking about money. But you can, make up a game at home. So, like for example, we used to sometimes collect DVDs, and we used to pretend to sell them, or we'd have like toy cars and we'd line them up and just saying, which one do you think is worth more? Oh, do you think this one's worth it though? Because the wheels aren't very good on this. And like there's so many things that you can go as wild as them when it comes to using your imagination. But the classic one is also, I think, you can draw coins, you can cut out your own paper notes and stuff. There's so many things you can do. It's so much fun. So 100% though, do make it a playful thing. Don't start going into serious conversations, especially if they're really like 3 or 4. It is all about getting them thinking about money and engaging in the subject. So one day, as they grow and they develop their conversations about money, it isn't an alien concept to them.
It's interesting you mentioned materialism because I've got teenagers now, and my goodness me, yes, they are materialistic. And as they get older, when should they have their own bank accounts, things like pocket money? Because I know for me, there was a point where it just seemed easier just to pay for everything and not have to worry about apportioning pocket money.
Yes, so pocket money is a really interesting question. We've often had a debate in Money Week offices about how much should you give your children. Apparently, I pay mine too much. So pocket money is, I think it's, to be honest, I would never want to dictate to a parent that, you should give pocket money and this is how much you should give. But if you are thinking about pocket money and wondering when it's ready, when it's a good time to give your child pocket money, well, actually, as soon as they want to start buying things and you're kind of like, oh, actually, you know what, you really need this, and you want to start teaching them about wants versus needs. Now, this is such an important conversation to have with your children at some point. Is this something you need or is this something you want? So, i.e., if we go to the shops and I'm buying you school shoes, I know you need them, I must pay for them. But if you're asking me for a designer jumper, I don't necessarily want to get you that. So let's talk about how we might save for this jumper if you really want it. And because as they get older, it does become, I want this. And you don't want to keep saying no. But what you do, and you certainly, like I personally, I don't like ever using the words to my children, I can't afford it, because I think that puts out a negative sort of view about how I manage my money. So what I want to say, we can get that, but because it's quite expensive and we don't quite need it now, how shall we save up for it? So this is your pocket money. How many weeks do you think it might take you to get there? So as soon as they get to that stage of, can I get this? Can I get this? I think they're ready for pocket money. Now, how do you pay it? So we are in a contactless world. So we have to remember that even like at schools, they're all contactless now. So one of the things that there's so many like these prepaid cards that you can get. They're really good to start them off young, but at age 11, I think it's roughly the average age when they can also get their bank account as well, their own bank account, and they have their own debit card. A lot of banks are doing a lot around budgeting tools that they can use on their apps, etc. So they're really good to get them going with that. However, I will say, do not forget the importance of cash. I think children need something tangible to understand a concept like money. So I think it's okay if they still have a little bit of cash and a little bit of a card that they can also use. I love the prepaid cards because you can also monitor what they're they're doing on your own phone, and you can give them a boost in their pocket money, and they can request it. If I do this chore, can I do this? So there's so many like ways to boost their pocket money. So if they are at that stage where they say, "Oh, I really want this. I really want," and I know I've got a son who's obviously always asking me for his designer items. And I'm like, no, I am not spending all that money on that because I don't want to. I'm going to spend it on myself. And but we have a book, and it's goals, and we think about, okay, this is what you want. This is your pocket money, and this is how long it's going to take you to get there. Do you still really want it? And I might give you a boost along the way if you do this and that. So that's quite a nice way to kind of help them learn about the wants versus needs as well.
And that sets them on a really good path for learning how to save for things, understanding that sometimes you've got to work for something.
Yeah, I think that you always, like, even as adults, you really appreciate something when you really, really worked for it, rather than it just be given to you. It's like, actually, no, I really saved for this. It's so meaningful, and I've really planned for this. And sometimes you're like, oh, I'm glad I didn't rush into this because I actually didn't really want it as well. So, yes, it does set them up. And that's really, I think that's just a really important message. I always say it's like riding a bike. You have to take the wheels off at some point and let them fall.
What you said about not saying, I can't afford it, that's going to resonate with so many people because the last couple of years, to be honest with you, has been tough for a lot of parents. And just having to make choices when they get to the supermarket about what they can put in their trolley, and some of the branded items maybe that they've always bought suddenly they can't afford, and you get back and the kids open the fridge and they're like, where's this? And it's like, well, you've got that version, I don't like that version. That's been really hard. So how do you navigate that? How do you talk to your children about the fact that things have changed?
Yes, absolutely, and it does resonate with people. So by that, me saying I just don't like those words because I think it comes with negative connotations, and I want my children to think, oh, actually, I have managed my money, and I don't want them to think when I can't afford it. But when it's more about when they're asking for the big ticket items, like, no, I don't want to say I can't afford it. I'm like, no, we're going to work towards that. Everyday items, yes, it is a tough message out there. People are making cutbacks, and at that point, if it is your day-to-day spending, and I think it's really important to have a conversation with your children, say, like, this is our involve them in the household budgeting. Obviously, there will be an age, if they're really young, they're probably not going to notice that you switched over the baked beans from Heinz to the Tesco value. I don't know. They might and they might not, but as they get older, they will get fussy or more aware of these things. I know my children would be. So involve them in budgeting. Say, look, this is what we're going to spend on our groceries. We're spending way too much. So look at your one. Okay, I'll just tell you about how I've done it. So one way I've done it is I've kind of sat down with my children and said, look, we are spending a bit too much on groceries, and I think we're throwing too much away as well. Like, we're not going through it. So we're buying what we don't need. So what do we really need, and what shall we spend our money on? What are we not bothered about? And maybe shall we try a different version of something? So, and to be honest, they've been fine with it. They just know what they like. So it's fine. And I stick to what they like and ditch what they don't like. So it's been like involving them in conversations. If it's a really important conversation, and if it's something that's really denting your household budget, then I think it's really important just to sit down with the children and almost make it a family plan, so they don't feel like they're being forced to eat something, because that's the children's mentalities. When they feel forced to do something, they're all of a sudden defensive. Like, oh, I do not want to do this. I don't want to eat this. But the minute they're involved, it's like, oh, actually, we all agree to this, and it's quite good. Actually, I quite like it. So it's a bit like when they cook a meal. I find that if I involve my children in making something, it's so much like they're a lot keener to eat it than they would be like if I just made it for them, just gave it to them, like, eat these vegetables, like, no, don't eat. But oh, I helped cook this and it's really good. Do you see where I'm going with that? I'm just trying
Yeah.
to, like, yeah, I think it comes down to involvement, and they're not. I'm not, sort of like, saying that this isn't an easy conversation. It is an easy conversation because it's not an easy conversation. There are households that are genuinely, like, really, really are struggling and don't want their children to be involved. But I think sometimes it is. a good idea just to have a little bit of a conversation with your children, because they do pick up on things otherwise. But if you're open and honest with them, then they feel a bit more involved. And honestly, you'd be surprised at how engaged children can be. They are wonderful when they've got a little bit of understanding about something.
The one thing I have noticed about the cost of living crisis is that because we've all been in it together. So for a lot of parents, it's actually made it easier to talk about money, because it's not like, you know, your friends' parents aren't in the same boat. Everyone has been in the same boat. So in many ways, it's made that taboo of money less difficult to deal with.
Yeah, oh yeah, absolutely. I think generally the talk about money has become a lot more open, not just with children, but just between friends, etc. I had friends that would never talk to me about money, and now we're all talking about money because the interest in money has skyrocketed. We're all talking about money. Whether you haven't got enough or whether you've managed to save a bit during the pandemic, whether you want to know how to save it or how to spend it, whatever it is, we're all interested in money and we're still talking about it. There is some people still see it as a taboo and don't want to talk about it. That might be a different conversation, how to break the money taboo. But I think that does make it a lot easier. And the fact that we all, even now, like people just throw in, ever heard of the cost of living crisis? So I always grew up, like my dad would always make me turn off the lights and, like, why is that light switch on? Why is that light switch? And I'm just walking around turning off what we don't use in the house. So now my kids, they pick up these little habits anyway. But now it's so easy to just say, ever heard of the cost of living crisis and turn it off? It's just so much easier to say. It's become a little bit, yeah, it's not a joke. I don't want to say it's a joke, but it's brought money and the cost of things to the forefront of everyone's minds, and therefore it makes that conversation a lot more easier to have.
I know some parents get really nervous talking about things like interest rates, credit cards, tax, those kind of things, which actually we are talking about more. They are, headline news. You see them on the, news websites and the front pages of the newspapers. And kids don't tend to get taught much about that in schools. So it does fall to parents. So if they're thinking, actually, we've been talking about money, we've talked about budgeting, but I want to give them a bit more, but I don't really understand. Are there places that they can go to find that information to then start those conversations?
Yes, so absolutely. So I mentioned earlier, like a lot of the bank accounts, so even the prepaid banking accounts, have such great resources for children and parents to use. Go online and financial journalists, podcasts like this, are doing an absolute excellent job of educating the nation when it comes to money. Financial literacy has been poor in this country. We're all in a learning curve, adults and children, actually. So when you're teaching your children about money, take it as an opportunity to learn yourself as well. And books, there's so many great books. I've written one for children, which I've been told by a lot of adults that they love as well. It's called Get to Know Money. It is the basics of money. What is an interest rate? How does it work? However, I will also say is, if your children are old enough to have a prepaid card or bank account, definitely go ahead and open one of those for them, because that opens up the doors to have that conversation about how a savings account might work. And you can actually physically show them, look, this is the interest rate. And if you save this is what you will end up in a year's time. And just seeing that, that kind of opens up that conversation and helps that understanding. Now, I would just say, yeah, online, books, listen to podcasts, loads and loads of resources as well. And I know a lot of financial journalists nowadays aren't just writing news, they're writing explainers and stuff that really help people understand things. They're writing things for children, they're going out there. I do a lot of school talks, for example, and talk to children about money. And that's why I know how engaged they are. They are absolutely amazing and so interested. And what you mentioned earlier about the cost of living and the fact that interest rates, inflation, is pensions, all on the front page news, is amazing. And I did a careers fair recently and I spoke to children how I was a financial journalist. And I had comments like, wow, I was like, wow, they're actually interested in the fact that I'm a financial journalist, and normally that would not be of interest, but they are like, oh, what do you write about? Oh, money, and like what sort of things? Have you met Rishi Sunak? You know, like they're so. I think we underestimate how much they want to learn about money. So don't be afraid. So there are lots of resources. I'm trying to think what they are. Like I've mentioned podcasts. AJ Bell's podcast is obviously a brilliant resource for parents to go and learn and then teach their children. Books, go on a lot of the national papers, magazines, etc. They're all learning about money. There's so many resources. There's things like if you want to do like more sort of educational things, like there's Twinkle, for example, which you could print off worksheets, etc. There's so many initiatives out there. I don't think I could even list them. But maybe when you put this out, we can put them all in the comments because there are loads. And I really urge anyone that really wants to learn about it. And if you're not sure how to talk to your children about something, then take the opportunity to learn something that you should have learned at school because we didn't learn it at school because no one bothered to teach us at school. But it's a great learning opportunity for everyone, and it's actually quite interesting. I would say that I know, but it is interesting to learn about this. So, and I know, like, I remember I went to school once to talk to a group of year twos about money, and I had about 3 or 4 teachers come up to me and just sort of ask questions. They were so interested as well. So it's such an interesting subject, but we mustn't also forget that it's a life skill. So if there is, if you don't know the basics of inflation, if you don't know the basics of interest rates, I can't fudge around it. You really should.
Kalpana, it's been absolutely brilliant to talk to you. Thank you so much for your time.
Thank you very much for having me.
Kalpana Fitzpatrick there, and we will put some of those helpful websites she mentioned on our socials. So do take a look on there. Now, Danni, did she have a confession for us?
She did have a confession, Laura, and I have to say that of all the confessions that we have had so far, this is probably one that I feel the most. And before I let you go, this is your point where I ask you for your financial confession or dilemma.
I knew you weren't going to forget that. Okay, so I'm going to say like my confession is I like good stuff. Now I'm not going to lie, I do like to have the good stuff, but I work hard, I save hard for that stuff. But I probably spend way too much on skincare and makeup. I want to say I must stop, but I feel like I just like the good stuff, and that does make me sometimes spend on that. But I call it essential spending. But I in my defense, I do spend on things that I do need and enjoy, and I think it's important that money isn't about not enjoying things; it's about being able to enjoy the right things, and that's how I kind of deal with it, I suppose.
So I definitely have friends that are like this as well. And I think you can, if you get a great feeling and you enjoy doing self-care and good skincare, then you can justify it almost as a hobby, can you? I think so,
A
maybe.
necessity, I think, more than a hobby.
But that is all we have for this episode of the AJ Bell Money Matters podcast. If you enjoyed the podcast, then do leave us a review wherever you listen and give your friends and family a nudge. Send them the link if you think it would be helpful for them. We tried to cover a whole range of subjects because we know that everyone's financial journey is different. And we're going to do a series of articles over the next couple of months looking at how that journey can change as you go from your 20s to your 30s to your 40s and older. So make sure you check out the website, ajbellmoneymatters.co.uk, where you'll find all of our podcasts, articles, details of our events, webinars, and everything we have got going on.
And of course, you can get all of that direct to your inbox by signing up to our newsletter. You'll find the link on the website. And we love to hear from you. So join the conversation on social media. You can find us on Instagram, Facebook, X, and LinkedIn. Just search AJ Bell Money Matters.
Next time, we'll be talking about investing, but a different type of investing in yourself. We've got an interview with the founder of Tech Pixies, and we've also got a great episode coming up in September, all about your consumer rights with the Sun's consumer champion, Laura Purkis. So until then, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.